This is Awais with EMiniPlayer.net, and we're going to be going over this webinar on money and risk management. But before we dive into the risk management concepts, it's really important to get a handle on your beliefs, right? Your attitude towards the market. So we'll actually do a couple of quick polls here just to see where everyone's beliefs lie. If everyone could just answer that, do you believe it's possible to consistently make money from trading? Do you believe you can become consistently profitable? All right, so the idea behind this question really comes down to action. Because if you're starting off with the belief that, it's not possible to make money in the markets, it's, the game is rigged against me, or the markets are out to get me, they're always hunting for my stops, and it's just never going to work. Well, if you have that belief, then how much effort or action are you really going to put into this endeavor? If you're starting off with that belief set, how much action can you really put in to becoming a consistently profitable trader? Obviously, you're not going to put in the effort that's really needed to become consistently profitable. Trading is one of the toughest professions that one could get into. So when you're starting off with that base of a negative belief system, it reflects in your actions. And then what happens? Well, when your actions are not going to be, when you're not going to be putting in the effort that's needed and you're starting off with that negative belief, you're probably going to get negative results. And that's going to feed into your beliefs again, right? It's going to further confirm your belief. Like, see, I told you, no one can make money. And then that, of course, feeds back into the your action set, and it's just you get into this negative spiral where at the end of 1, 2, 3 years, however many years someone spends on this, you end up being a very cynical and negative person, right? You walk away from trading with a very negative view, and really it could just be that from the get-go, your beliefs about the market and about this business were negative to begin with, and you never really gave yourself a fair shot at becoming a consistently profitable trader. So it's very important to just take some time out and really just identify and just get an inventory of your beliefs. Just sit down, just write down what you think about the market, right? When you're approaching the market, what are your core beliefs? And take the first answer that comes to your head, because that's really the one that you're going to be working with at a subconscious level. So very important to have the belief set right so that we can put in the effort that's needed to become consistently profitable. And once we do that, over time, we'll start seeing the results that we want. And that'll actually further enforce our belief that, hey, this is a legitimate business to get into. This is a profession, and you approach it like a business. And that further fuels your actions, further improves your results. So now your belief system is really working for you, and it'll reflect in your results. But when you start with that negative belief system, you're really setting yourself up for failure. So very important to get that right. Now, as far as risk management goes, the key for risk management, before we can even really dive into the details, is accepting the risk. And how do you accept the risk, right? I mean, everyone says, well, you have to accept the risk. Well, you accept the risk by understanding it. You have to understand how risk works, the different variables involved, the different inputs that go into it. And once you understand risk, then you can mentally work on accepting and being comfortable with the risk before you put on the trade. So this isn't something where you put on the trade and now you're like, is this really how much I should be risking on this? And you're constantly fiddling with position sizes, and on this one I'm going to put a 2 lot, on this one I'm going to do a 4 lot just because I feel better. It feels, my gut tells me it's a better setup, so I'm going to put a 4 lot on it. It goes a little bit against you, and this can't be happening. I'm right. I'm gonna add to my position. I mean, all those core things that the fundamental mistakes that traders make. A lot of them are rooted in not having a good understanding of risk, and then not accepting the risk before they put on their position. So they're coming up with a risk plan on the fly, right? And because of that, their results are not consistent, and then they wonder why. I mean, if you're going to be changing position sizes on every trade, and you really don't have any written plan then how do you measure yourself? How do you judge, the trading results? So these are really the fundamentals that we're talking about. Now, once you've understood and accepted the risk, then you focus on the process of trading well. And what's the process of trading well? That's executing your plan. So all of it kind of starts at the understanding and acceptance, and then it feeds into the process and then the execution. A lot of traders jump straight to execution. They don't really have any trading plan. They don't have any process in place. The term risk doesn't even really come to their minds. That's why a lot of beginning traders don't really even use stops. They just kind of jump in and jump out on the fly, just trading from the seat of their pants, and the results show it. So very important to accept the risk. And now to accept it, of course, like I mentioned before, we have to understand it. So we'll jump into that. So we're going to do a quick risk of ruin exercise. And I have an Excel spreadsheet here that I'll be sharing with the group, so you guys can use this later on. But let's look at that. So starting with $20,000 of capital, risking 1.5% per trade, so $300 to start off, you would have to have 135 losing trades in a row, right? So if you look over here on the left side, this is the trade number and how your capital is affected by a loss. And then we just scroll down, all right? And what we do is once your risk hits $100, 1.5%, then we just use $100, a flat risk amount, because obviously if we keep using percentages, it's going to go down to $75, $50, which is unrealistic. At the minimum, I'm assuming that you're trading a one lot and using 2 points on your stop loss. So at this point, we drop to a flat $100 risk. And if we just keep scrolling down, we can see that to get down to a $500 balance, it takes 135 losing trades in a row. And if you're trading 3 trades a day, that comes out to, I think, about 43 days in a row of losses. If you're taking 5 trades a day, it comes out to, I think, 27 days of losing in a row. And we'll look into the probability of that happening. So once you understand the risk of ruin, the idea behind this exercise, is to show you that any one given trade is not going to have a huge impact on your account, right? The next trade that you're putting on, it's not a make it or break it trade. I mean, look at how it affects your account and look at how many in a row you would have to actually blow your account. So very important to understand this idea. It's very basic, it's very fundamental, but this will help you understand risk, and it'll help you mentally accept the risk when you're putting on the trade. Because once you know that, hey, I'm risking 1.5% and it's not going to kill my account, this is one trade in a series of hundreds of trades that I'm going to be taking, it just takes the edge off. Then you're not panicking and you're not over managing and micromanaging your position. It makes you a more disciplined trader. So that's the idea of this exercise. And of course, I will be making this available. So just plug in, your account size and just play with the risk parameters. Now, a lot of traders start off with very small accounts, and then they're risking a large percent of their account when they're trading in the beginning. So let's actually take a look at that, right? If we're starting with a $5,000 account and we risk, let's say, some traders do risk 5-10%. How long before we blow out? About 33 trades in a row, and you're out. Now, what about the person who's starting with a $5,000 account and they risk 10%? Right. So at this point, it only takes 20 or so trades, and they're out of the game. They've blown their account. So this little exercise shows you the importance of being well capitalized and the importance of using prudent risk management, right? Not risking 5%, 10% on any given trade. And that's why, I really like these parameters of starting with 20,000 and risking 1.5%, which still gives you, you can trade multiple lots. You can easily trade 2 contracts on the account. Wayne asked, is that assuming no winners? Yes, that assumes that there are no winners, and this is how many losses it would take in a row to blow the account. And again, the probability of this happening, if you have even a half decent method, is very, very low. So once we've done the risk of ruin exercise, that should take the edge off and just give you a better understanding that, hey, this next trade is not a big deal. Mike C is asking that 1%, he thought 1% was ideal. That really depends on, your system, your method, and what you're comfortable with. If you're comfortable with putting on 1%, then you should stick with 1%. There's really no, rule of thumb on what it needs to be. It really depends on your win rate. If your win rate is 80%, then you can risk 3 or 4%, and it's fine because the probability of you having 3 or 4 losers in a row is very low once you have an 80% system. So it really depends on, the method you're using, but I personally like to use between 1 and 1.5%. So now moving on, when we're measuring or looking at a given method, very important to understand expectancy, right? And understand reward to risk. And we'll do a quick exercise in Excel to understand expectancy. And the really interesting thing that we're going to do here is compare an all-in, all-out system versus scaling out, not scaling in, going all in and scaling out. So let's go back to Excel and let's look at expectancy analysis using that base $20,000 account, trading 2 lots, and this information is based on 100 trades. So if you're going all in, all out, and you have $600 is your average winner, $300 is your average loser. So basically you're using a 3-point stop on a 2 lot, and you're looking to get 6 points on the trade. So 2-to-1 reward to risk, and we're assuming a 40% win rate, right? People focus a lot on win rate. So you can see that even with a 40% win rate, the result after 100 trades is $6,000. So on a $20,000 account, based on 100 trades, position size of just 2 contracts, with a 40% win rate, you're at 6,000. Now to break even on this, you actually need only a 34% win rate. So the question you have to ask yourself is, how focused are you on reward to risk? And how focused are you on being right and getting every setup right, winning, ringing the cash register, right, over and over again? The more you focus on accuracy and win rate, typically, this isn't the case with everyone, but typically traders that focus more on win rate tend to focus less on reward to risk. And mathematically, if you have a very high win rate, you can have a 1-to-1 reward to risk, and it'll work out fine. And that's something we can quickly do here, right? Let's say we have a 1-to-1. We need a 50% win rate, obviously, to break even, and then anything above that is going to produce positive expectancy. So if you have a 70% win rate, you can use a 1-to-1 reward to risk. But by using this very simple spreadsheet, you can assess your own trading. You can see what your average winner is, what your average loser is, what type of win rate you have, and see whether that's a positive expectancy method. And if not, then you can adjust these parameters, and you can say, well, okay, if I give up a little bit on the win rate, but I shoot for bigger winners, how does that affect me? I mean, think of if you have a system that does 3-to-1 reward to risk, right? Now you only need a 25% win rate to actually break even. Now this doesn't account for commissions, but if you had even a 30% win rate, it's a positive expectancy system, and not many people think about that. The key point really I want to make with this one is that the win rate is not the most critical aspect of a method. I mean, you can be right half the time, 50%, but if you're using the proper reward to risk, you're looking at a very, very profitable method. And that's really the key idea that we want to take away from this little exercise here, is that win rate is just one variable, and it's not something that should be obsessed over. As long as you're managing risk and your risk to reward is in line, and you're using 2-to-1, ideally, minimum 2-to-1, but if you can shoot for more, then, that's even better. Then, if you're right even half the time, I mean, this is on a $20,000 account. So if you're right even half the time and you're trading just 2 lots, this is the result you're getting. Very, very profitable method at 50%. But, most people don't really think of it this way. They're focused on just getting every little trade right, and usually the reward to risk suffers, right? They might be risking 3 points and then they scale out, or, they just take the whole thing off at positive 1.5. And then we can see how that affects it, right? If you're risking 300 and you're making only 150, you need about 70% to make this a positive expectancy system. And, even at 70%, that's probably going to cut in, you have to account for commissions and other costs. So really, you probably need more like a 75 or 80% win rate for this to really make sense, right? So when you're using reverse reward to risk, right, you're risking 300. So you're risking 2 for every $1 that you make. You need an 80% win rate to get very similar performance to, if we flip this, if we flip that ratio, you can see that you only need a 40% win rate to get the exact same result. So now it's going to depend on everyone's personality and what they find comfortable, what they feel is the right method for them. But just know that the math has to make sense. I mean, you can't have a negative expectancy system, and it might feel good, but it's not going to feel good for too long because you're going to blow your account. Now let's compare this 2-to-1 reward to risk with a 40% win rate to a scaling out strategy. So let's actually, now over here, the inputs that we're looking at, when do we first scale out? So we're taking the first scale out at 3 points, and we're exiting at 6 points. On the prior one, we were risking 3 points and taking the whole position off at 6 points. This one, we're scaling out of half at 3 points, and we're risking 3 points, and the final exit is going to be 6 points. So when doing a scale out analysis, what we have to know is what is the win rate on the first unit, and what's the win rate on the final exit. With using our support resistance zones, getting a win rate of 70% is pretty doable on the first scale out. And then the win rate, we're just assuming is 40% on the final scale. So we can see that, using this system, we actually get a higher profit number at the end, right? The result, whereas over here we were making 6,000, over here we're making 9,000. But that's really based on getting that first scale out, right? So in this case, the scaling out, if these are parameters you're working with, might seem like it makes sense. But here's the thing. If you're getting 70% on your first scale, let's go back to our all-in, all-out system and change this to 300 because you're exiting both contracts on the first scale and you're getting 70%, right? And we can see that the all-in, all-out system actually performs much better. So mathematically, if you have a high win rate, right, on that first scale out, it actually makes sense to just take the whole thing off. It's, if you're getting a 70% win rate, it makes more sense to take the whole thing off. You're going to make more in the end, right? The expectancy is better just taking the whole thing off if you have a 70% win rate on your first scale. But the important thing here is that, we're working with very rigid numbers, right? We're assuming that the second one we're going to take off at 6 points, whereas that might not be the case. So it depends on how you trade, depends on your personality. And, in reality, when we actually practice trading, the results can be different, obviously. But, it's important to understand some of these fundamentals so that we can then go to work and, make a trading plan that suits our personality or the way we view the market, our beliefs, and take it from there. For example, if on this one, even if you have 40% win rate, let's say, all right, 2-to-1, if you're the type of person that just simply can't hold your trade and the 40% win rate is something that's really going to mess with your head, and this is a system that you simply cannot execute, right, psychologically, then scaling out is a much better way to go for you. Because even if you make less money scaling out, it's better than losing money on a system that you can't execute. And that's why, it's really a mix of taking your psychology, taking your beliefs, kind of how you view the market and everything, and then coming up with a plan that's in alignment with your own beliefs and something that you feel that you can execute with discipline. If the scale out method is something that you can execute with discipline, then that's the way to go. The 40% win rate and the 2-to-1 or 3-to-1 reward to risk might be better mathematically, but if you can't execute it, what difference does it make? So we have to take all these different variables into account, but really the main thing we need to take into account is ourselves and our own psychology. So again, this is a spreadsheet that it's based on a very simple 2 unit. It assumes 2 units. I mean, obviously you can change the numbers if you're trading a 10 lot, and you can change the dollar amounts, but it assumes that you're scaling out of half. And if you had a 3 unit system, you would simply add the win rate for your second scale out, and then the win rate for your final, and how much you're making, and the spreadsheet would tell you whether you have a positive expectancy system. Okay, so with our expectancy analysis, we saw that our break even at 40%, it's a positive expectancy system even at 40%. Our break even rate is actually about 34%. The other formula that's in that Excel spreadsheet tells you the maximum numbers of winners and losers in a row that you can expect given your win rate and given your sample size of 100 trades. So the maximum number you can expect is 9 losers in a row at the 40% win rate and 5 winners in a row. Now, the importance of knowing this stat is that it allows you to figure out how much risk you should put on every trade. And it also tells you that, hey, if you get 9 losers in a row, I mean, that is something that could be expected given your win rate. So don't freak out. Don't start changing your system just because you had 9 losing trades in a row. Now, most likely, if you have a good method, you're not going to have 9 losers in a row. This is a maximum. But if you do, it doesn't call for changing your methodology, becoming undisciplined, and just going back to the drawing board with your method, because you still have a profitable method. It's just running into a losing streak, which happens. So using our 1.5% account risk, we can go back to our spreadsheet and we can see that, okay, if we had 9 losers in a row, where does that leave our account? If we're starting with 20,000 and we do hit 9 losers in a row, we still have 17,500 left. We're still at a pretty comfortable spot. So even getting 9 losers in a row is not going to kill this account, right? And it's important to understand it and believe it and just know it. All right, so moving forward, once we have this understanding of reward to risk, expectancy, the next key thing becomes position sizing. And this is an area where a lot of traders screw this up. Position sizing is something that I personally had a big problem with when I first started, and I know a lot of traders have an issue with. So we're going to systemize, our risk management. We want to be fluid with our market reads. We want to adjust our reads to the market context, but we want to be very rigid with our risk management. Because if we get this one thing right, the risk management, we can screw up a lot on the other end, on our methodology, and still come out ahead. But if we screw this up, the method could be awesome, and it's not going to make a difference. So very important to risk the same percent of capital on each trade. We were working with our example of 1.5%. So what we do is at the beginning of the morning, before the market opens, we set the dollar risk per trade based on the percentage, right? So if we're risking 1.5% on a $20,000 account, we say, okay, we're going to risk $300 per trade. And then we use that same fixed dollar risk on every trade all day, right? This isn't something that's being adjusted intraday. We're going to use that same amount, $300, on every single trade for that day. So we can see that, with position sizing, if we're risking $300 per trade and we're using a 3-point stop, then our position size is automatically 2 contracts. Now, if we spot a setup that allows us to use a 2-point stop, then we can use 3 contracts, right? So position sizing is a function of risk. It's not a function of how I feel. It's not a function of my belief in the setup or how strongly I feel that the market is going to do something. It's mathematical. It's based on how much I'm willing to risk. And as long as you're following this proper risk management, you're not going to have a terrible day. And at the same time, you're rewarded for becoming a better trader over time. And if you get to a point where you can use tighter stops, where you can use a 2-point stop or 1.5-point stop, well, now you can size up more on the same setup. So you really get paid over time as you increase your skill, increase your, just become better at execution, you really get rewarded for that, because now you're risking a fixed dollar amount, and because you're risking a fixed dollar amount, you can adjust your size based on how much, how wide of a stop you need to execute that trade. And as far as stop losses go, you want to give yourself enough room that the trade can work out. So stop loss should not be too tight. Some people are comfortable using 6 ticks, 2 points, whatever, but really it's based on volatility, right? I mean, back in 2008, when the market was putting in 50, 60 point days on a regular basis, 2-point stop wasn't really working out. It was more like a 5-point stop that you had to use at that time. But it's okay because the range was so wide that the reward to risk was still in line. You might have been using a 5-point stop, but you were also getting 15 points on some of your winners. So that was okay. Always just kind of keep these it's very basic stuff, but these are the fundamentals of putting together a trading plan. And if you don't have the fundamentals, then all the other stuff is not really going to fall into place. But if you get this stuff right, if you get position sizing right, your chances of becoming consistently profitable are exponentially higher. And if you screw up position sizing, then the chances of you becoming a profitable trader are exponentially lower. This is one area that you really should look into your own trading and look at how much attention you pay to position size. It's the single most important factor to becoming consistent, and it's one that's often overlooked. Doug was asking, if one has a larger account, do you still use 1.5%? Absolutely. Account size has really nothing to do with it. You could be trading $1 million and still risk 1.5%. You would just be trading bigger size. Okay, so that really covers the majority of, as far as the basics of risk management go. The other thing I wanted to talk about is measuring your performance in R multiples. So how much are you risking on a trade, right? We define that as R. How much are you risking on any given setup? So this is something where you're putting on the trade you have to track. So for example, if you're going long one contract at 1430, 2-point stop, so you're risking $100. If you exit at 1434, you would count that as 2R. You made 2 times your risk. If you exit at 1432, you would count that as 1R. Now, if you took a 4-point stop because the market just sold off and it slipped right through your stop loss or whatever, then you would count that as a minus 2R on your spreadsheet. And the reason for this is that it allows an apples-to-apple comparison, allows fair comparison between different trades. Because you might look at your spreadsheet with all your trades, and one trade might say, oh, you made $1,000. The other might say you made $500. But really the important thing is not how much money you made, it's how much you risked to make that money. If you risked 10 grand to make $1,000, but then you only risked let's say $50 to make the 500, which one's the better setup, and which one should you be allocating your capital to? So very important to track your performance in terms of risk. For every setup, for every trade you take, jot down how much you risked, what your initial risk was to put that trade on. So very important to do that, and that way over time you will actually be able to identify the best setups. This is something that I think you guys can start doing right now if you're not doing it already, is keep track of how much you're risking on every trade, and then you're obviously keeping track of your profits, how much you made on every trade, how much you lost, but then also track how much you made, how much you lost in terms of risk, in terms of R. So you can say, oh well, I made 2R on this trade, I made 5R on this one, and right away we know which one the better setup is, right? It doesn't matter, the money doesn't even matter. You don't even have to say I made 10,000 on this trade. Who cares? That's your account. But if you tell me that you made 10R, well, that tells me that was a very good trade. You risked $1 to make 10. I don't care what size you put on or anything else, but right away it allows us to compare different setups and different trades on a level playing field, right, in terms of risk. So very important to measure your performance in terms of R multiples. How much are you making? Well, that was our webinar on risk management. I hope everyone found it useful, and it gives you some new ideas, or motivates you to go back to the drawing board with your own plan and at least assess it in terms of risk and really have a better understanding of risk management.